In the summer of 2006, many Americans believed home prices could only move in one direction. Real estate agents said land was limited. Banks said financing would always be available. Television shows flipped houses in weeks, and neighbors watched their property values rise month after month. Owning a home no longer felt like a long-term commitment. It felt like a winning investment that could be sold at any time for a profit. Then, almost quietly, something began to change. Listings stayed on the market longer than usual. Sellers started lowering their asking prices by small amounts, hoping buyers would return. Mortgage applications slowed. At first, it did not look like a collapse. It looked like a pause. But pauses in housing markets often hide something deeper. Today, signs of the same shift are appearing again, and they are unfolding faster than many people expected. Home prices in several parts of the United States are no longer rising steadily. In some cities, they are falling month after month. In others, they are dropping sharply as sellers compete for a shrinking pool of buyers. The speed of the change has surprised economists, homeowners, and investors alike. To understand why this is happening, it helps to remember how housing markets usually turn. They rarely collapse overnight. Instead, they move through a series of quiet stages that gradually transform confidence into caution. The first stage is usually denial. For years, low interest rates made borrowing money unusually cheap. After the global financial crisis of 2008, central banks kept rates near historic lows to stimulate economic growth. Mortgages became affordable even as home prices climbed. Buyers who might once have qualified for a modest house suddenly found themselves able to bid on much larger properties. Demand surged. Construction companies rushed to build new homes, but they could not keep up with the number of buyers entering the market. Prices climbed steadily, and in some cities they rose at speeds rarely seen before. When the COVID-19 pandemic arrived in 2020, the housing boom accelerated even further. Millions of Americans began working from home. Many left expensive urban apartments and moved to suburban houses with more space. At the same time, mortgage rates dropped to some of the lowest levels ever recorded. The result was a buying frenzy. Homes received multiple offers within days of being listed. Buyers waived inspections and offered cash above the asking price. In many neighborhoods, property values increased by more than 20% in a single year. For homeowners, the rising prices felt reassuring. Their houses seemed to become more valuable simply with the passage of time. But housing booms often carry the seeds of their own reversal. The turning point arrived when inflation began spreading through the broader economy. Prices for energy, food, and everyday goods started climbing rapidly. To slow inflation, the Federal Reserve began raising interest rates at a pace not seen in decades. Mortgage rates followed the same direction. A buyer who could secure a 30-year mortgage at 3% suddenly faced rates of 6 or 7%. That shift dramatically changed the math of homeownership. Monthly payments increased by hundreds, sometimes thousands of dollars. For many potential buyers, the higher payments pushed homeownership out of reach. Demand started to weaken. At first, the effects appeared subtle. Open houses attracted fewer visitors. Homes that once sold within days began sitting on the market for weeks. Sellers, still remembering the frenzy of the previous years, were reluctant to reduce their prices. This is the second stage of a housing slowdown: hesitation. Sellers hold on to old expectations while buyers adjust to new financial realities. The two sides wait, each hoping the other will move first. But housing markets cannot remain frozen for long. Eventually, inventory begins to rise. When homes stay unsold, more listings accumulate. Buyers suddenly have choices again. Instead of bidding against one another, they compare properties and negotiate. Price cuts begin appearing in listing descriptions. At first, they are small, $5,000, perhaps $10,000. Sellers describe them as motivated adjustments, suggesting the reductions are temporary. But as weeks pass without offers, the reductions grow larger. In many cities today, that process is already underway. Real estate data shows a steady increase in homes with price reductions. Properties that would once have sparked bidding wars are now competing against dozens of similar listings. The third stage of a housing shift is recognition. Buyers realize they have regained leverage. Sellers realize the market has changed. This moment often marks the beginning of faster price declines. Housing is unlike most financial assets. Stocks can drop in seconds, but homes move slowly because each transaction involves negotiations, inspections, and financing approvals. Yet once price reductions become common, the psychology of the market can shift quickly. A homeowner who planned to sell next year may rush to list now, fearing prices will fall further. Investors who purchased rental properties during the boom may decide to exit before values decline. More listings appear, and when supply rises faster than demand, prices begin adjusting downward. This pattern is now visible across several parts of the United States. In some regions, prices have fallen only slightly from their peak levels. In others, particularly areas that experienced the fastest pandemic-era growth, the corrections are more pronounced. Cities that once attracted waves of remote workers are seeing some of the sharpest changes. As companies call employees back to offices, migration patterns are shifting again. Demand that once surged in certain housing markets is now fading. Another factor is affordability. Even if home prices remain high, rising mortgage rates mean buyers must dedicate a larger share of their income to housing payments. Economists measure this using affordability indexes that compare wages to mortgage costs. In many regions, these indexes have reached levels not seen since the mid-2000s housing bubble. When housing becomes less affordable, fewer buyers qualify for loans. That reduces demand further. Meanwhile, construction companies are completing homes that were started during the boom years. These newly built houses are entering the market just as buyer activity slows, adding additional supply. For developers, holding unsold inventory is expensive. Construction loans accumulate interest, and maintenance costs grow over time. To move properties quickly, builders often reduce prices or offer incentives such as mortgage rate buy-downs and closing cost assistance. Those incentives effectively lower market prices even if official listing values remain unchanged. The final stage of a housing correction is acceptance. Sellers begin pricing homes according to the new reality rather than past expectations. Buyers return cautiously, knowing they may find better deals than before. The market stabilizes, but usually at lower price levels than during the peak. History shows that housing cycles rarely move in straight lines. After the crash of 2008, many analysts predicted that Americans would avoid real estate investments for decades. Yet within a few years, low interest rates and population growth revived demand. Today's situation is different in important ways. Lending standards are generally stricter than they were during the subprime mortgage era. Most homeowners hold fixed-rate mortgages secured during years of low interest rates, meaning they are less likely to default. However, the forces shaping housing markets remain the same: supply, demand, and the cost of borrowing money. When borrowing becomes expensive, demand weakens. When demand weakens while supply grows, prices adjust. What surprises many observers is not that prices are falling in some areas, but how quickly sentiment has shifted. Only a short time ago, buyers feared being permanently priced out of the market. Now some are waiting on the sidelines, expecting better opportunities if prices continue declining. Housing markets often move slowly at first and then accelerate once expectations change. In the coming months, economists will watch several signals closely. Mortgage rates remain one of the most powerful drivers of housing demand. If interest rates remain high, affordability pressures will persist. If rates fall, buyers could return quickly, stabilizing prices. Another signal will be inventory levels. A sharp increase in homes for sale usually places downward pressure on prices, while limited supply can support values even when demand weakens. For homeowners, the situation is less dramatic than headlines might suggest. A falling housing market does not erase the practical value of a home as a place to live. Many families purchase their properties with long-term plans rather than short-term speculation. But for investors and policymakers, the direction of home prices matters greatly. Housing influences construction employment, consumer spending, and the overall health of the economy. When prices rise rapidly, wealth appears to grow. When they fall, that perception can change just as quickly. The story unfolding today is still in its early chapters. Some regions may experience only modest corrections. Others could see deeper declines if economic conditions tighten further. Yet the pattern itself is familiar. Housing booms generate optimism. Optimism encourages more buying. Eventually, the cost of borrowing rises, affordability weakens, and the market begins to cool. What first appears to be a brief pause gradually reveals itself as a broader adjustment. And by the time most people realize the shift is underway, home prices are already moving in the opposite direction.